From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those who champion market growth and anchor the nation's economy, small businesses, and entrepreneurs.
Hey there. Welcome to another episode of the Simple Numbers Profitability Playbook Podcast. I had no idea what episode. Yeah, I did, but I have no idea what episode. I forgot already. We're like 4 or 5 into season 2. I swore I was going to look and say it, but that's just not my style. So it's episode 4 or 5 of season 2. It'll be on there when you see the title, but I'm Mike Maxon. That's Brandon Gray, and the talent himself is back. Mr. Greg Crabtree making a special appearance for us again to give him update on the 100 company model, which he loves talking about so much. But first, Brandon, we were kicking it around before, man. What you watching these days?
All right, so I don't watch a lot of TV, but occasionally, you got a few minutes before you go to bed or what have you. So I've been on this thing on Netflix or Prime or what have you, watching Westerns. So Hell on Wheels is one that I'm watching right now. A lot of good violence, pretty good story, nice plot. Just something completely different from what I do every day.
Now I'm going to watch it because I love violence. It has to be, I just think that makes a movie. I just can't watch anything.
I did Blinders before that, thanks to Jap Prince on our team, who's Canadian or British. We're not sure which one.
I do want to watch Peaky Blinders, but I will say this, on Amazon, I caught this movie. There is violence in it, but it's called Blink Twice. It's like an Amazon original. It just came out. That's a freaky movie, man. It's a psychological thriller. Yeah, that's a messed up movie right there. Wait, what do you watch? Like math videos or?
So, David and I love to watch the British crime dramas on BritBox. So if you want to watch probably the best miniseries ever produced, probably maybe this side of Game of Thrones, you gotta give it its props. But in terms of just drama, there's a series called Endeavor. It's 9 seasons, typically longer form episodes, generally hour and a half episodes. But I would put Endeavor as my favorite all time 9-season binge watch series.
Really? All right.
Yeah.
Hey, we're about to.
You don't find out until like season 9 why it's called Endeavor.
Hey, we're about to go into that no football dead zone.
Yeah.
This is going to hurt.
Hey, the Alabama's a basketball team now. So.
They are. Hey, number 2 right now. I think they play Auburn here. Number 1 versus number 2.
Or number 1 in the coaches poll, who matters.
We had to throw Alabama in there with these two. So.
Saturday, it's Alabama Auburn. So we'll either be all smiles next Monday or canceling the podcast.
Yep.
That's right. Well, awesome. Well, all right. Well, Greg, kick us off, man. What do you got for us on the 100 company model?
Well, I mean, certainly, what we've seen is, continued resistance of market growth. And so, let me first, state the obvious. It is really, really hard to measure GDP, gross domestic product. So that is the output of the U.S. economy. Keep in mind a couple of things for all of our listeners. Number one is over 60% of the U.S. GDP are privately held businesses. At this state of 2025, in middle of February of 2025, the U.S. government knows zero about the economic activity of those 60+% businesses. And some people will say, well, they have tax data. Well, most of them haven't filed returns yet. Number 2 is, we don't submit detailed payroll information submitted in summary form until, and you just don't really draw economics from those issues. And so it's a major gap. Now, I'm not promoting the fact that we want the government interfering in gathering data from us every month, okay? But
so good at it.
It is a major blind spot because realistically, I mean, the government statistics people take publicly available data and make some wild ass extrapolations and make a guess that they think it's not going to roil the market. And we've been tracking our sample company set, started with my Simple Numbers 2.0 book, and my base year was 2013. And we've been tracking it every year since then. And then, about 4 or 5 years ago, we started updating it monthly just to get this read of trend.
Would hit, yeah.
Oh yeah. And it's really been fascinating because we get to see, this micro level of companies that we feel highly confident of the quality of the data, because the data we touched, it's not distorted. It covers all different industries. I mean, there's not an industry for the most part that we don't have some touch to. We have clients all over the U.S. and we only use our U.S. clients. So we have clients in Australia and Canada, and some dotted in various, Dubai and places like that. But we stick to just the U.S. companies, and really even there, we've got to make a reasonable guess at saying, if we look at 2024, it was 8.6% up. So this is roughly 1.2 billion of revenue. And so 100 companies, roughly 11.2 million of revenue on average, some bigger, some smaller, but we don't put any super small companies, and we don't put some of our, any client that we have that's over 100 million, we don't include them. So the really big ones, we keep them out of the model as well for distortion purposes. And really what we see is with that 8.6% revenue increase, labor increased at 9%. And what that's telling you is that there weren't 9% more people to go hire. I mean, I would say across our clients, that they're pretty much on average at the same head count. With a few that are ahead, there's plenty that are down. And so when you don't add bodies, then it's a good indicator of how much the growth is relative to just inflation. I'll give you a good example. So we have a HVAC group, mastermind group is about 12 companies, a little over about 120 million of combined revenue as a group. And with that group, when I did their last session last year, I looked back 3 years, and they were up 66% over a 3-year period. So we went around the room and I said, okay, what was your head count 3 years ago? And we felt like pretty confident that the head count increase over the last 3 years was less than 10% cumulative. And so what that tells you is it's 56% inflation in that industry. Now, HVAC is a classic example of a necessary business. When you're hot, you need them. When you're cold, you need them. And so we're not going to just grab an extra blanket or bring out the fan, for Sunday at church. You're going to do something about it.
And labor's already scarce. Labor's already scarce too in that industry.
Yeah. And so, you're, for every new technician trained, you're losing one to retirement. Right. And so it gives you a good example, that group. And so what we're seeing in the overall model is, I would say that last year's economy was flat. I call it even. Now, going into the election, I would have called it 2% down. So we did see a fourth quarter elevation in the market, as we came in, and it started in October as people felt good about where they thought things were going to be heading, because regardless of which side won, they just wanted to know somebody was going to do something. And what business doesn't like is when nobody does anything and you're just kind of stuck. And so we saw this pretty much for late 23, all of 24, leading up to the election, is everybody just sitting on their hands, for the most part. And then a little bit of release post-election. But the problem is in the U.S., we've got 3 holidays that just destroys all productive capacity in Thanksgiving, Christmas, and New Year's. And so it still was somewhat muted, but we started to see people, as we say in the South, fixing to get ready. And then as we saw January come, you saw a little more energy, but it continues to be what I call the upstairs, downstairs economy. When we take our 100 company model and split it between the companies that are up year over year versus the companies that are down year over year, what you see is the companies that are up 19%. The companies, and they're up 18.5% revenue as well. I mean, 18.5% labor. So once again, these are companies that are up, but for every dollar of revenue that they're getting, they're spending more in labor and raising prices And so we're still seeing probably a significant inflationary element to those necessary companies because they're necessary. They can raise prices as their cost input increases. No, they're not egregiously profitable. So don't get to thinking they're ripping everybody off. No, they're staying at our normal target of profitability of between 15 and 20% profit to gross margin, not profit to revenue, profit to gross margin. But the downs are down 9% and their labor is down 6%. Now, what that tells you is they're having trouble cutting labor as fast as they're declining. And what's happening is it's more so in the management labor part that they're not cutting, because direct labor, they're staying right on target of what their normal direct labor efficiency is. So in your mind as a business manager, if you're a discretionary business, you are rapidly adapting your direct labor model. But what you're holding on to is your management team and not really hitting the reset button and rebuilding. The management team to say, we got to look at this differently and come at this problem a different way. Plus, we've seen that group, whereas we're seeing the ups, they're at 18% profit to gross margin. The downs are down to 11% profit to gross margin. They were at 15% profit to gross margin 2 years ago. So they've seen an erosion of that profitability. Now, I think we're at the base level demand of the discretionaries. So I don't know that we're going to go much lower than here unless we have some other disruptions. And that's we'll talk about as we kind of read, read kind of what our thinking is of what our analysis of Trump's first 100 days in office are going to look like as we've seen some initial policies come out and some that we're still waiting on. Hey, we want to hear what you're thinking, coming up. One other thing that I will say, when we take this 100 company model and break it into the quartiles of the top 25 companies in performance, middle 50 and bottom 25, the smaller ones and the largest ones are at the best levels of profitability. It's the ones in the middle that are struggling to hit their profitability target. And so those start to indicate that you're kind of in the no man's land of getting to that next level as a business. And like I talked to a client today and I keep reminding him, it says, well, what is your goal? Revenue or profit? I mean, sometimes you can't get both. And last time I checked, I'd a whole lot rather have profit than revenue. And so there's people that are emotionally in challenged markets holding on to revenue that they need to probably bring it back a notch or two, get profitable with there, and then wait for if there is going to be in their sector a release of activity. Now, there are some sectors that there's activity, but the question is do you have the labor to go get it? Do you have the financing, the ability to turn it over? We still love to teach our clients how to grow cash positive whenever possible. But we're certainly seeing some reversion back to, I would say, more onerous cash flow terms from vendors and customers, trying to push their way. And so we still recommend, if you don't ask, you don't get. And so just keep asking for terms that are fair. I always refer to this as the economic fairness doctrine. As I'm spending money on your behalf, you should pay me something. And because I don't have bank attached to the end of my name of my company. And I think that is kind of a good, structural way of approaching the argument fairly. But some of the bigs just cram it down. And sometimes you have to make a call. I don't think I want to do your work. And we've actually, if you're the best, we've seen some of those bigs come back to you with, don't tell anybody, but we're going to work with you. We'll find a way.
Greg, what are you seeing in terms of, and I know you brought it up sort of with the necessities and stuff, but on a broader scale, because I know I've seen it. I was at the CEO group, technology group I was presenting at down in Orlando this past week. Very beautiful down there, by the way. And a lot of people were talking about being at the top of the market on their pricing. Almost sort of they've hit that sort of ceiling. Have you seen a lot of that? People able to get more? Because I mean, that's a big conversation in terms of, because we have the cost going up on labor and your OpEx.
Well, I think it's going to vary by business. To say you're at the top of the market if you're in a market where there's growing excess labor. And I did see there was actually a report out recently. I forget where the source was, it may have been Wall Street Journal, but one of the biggest areas of available labor was tech workers. And so I think there's a reset in a lot of the tech workers, but to get like an MSP type worker, they may be at the top of the market, but once again, I think you've got to look at your labor structure and, go back to, the Simple Numbers 2.0 book and look at the chart of where we talk about the career labor efficiency curve. You may have to transition some of your most expensive people to a different job with another company because you can't afford their cost. They are not profitable. As you may like them, they cause you no grief, but you can't be profitable. And
Top heavy.
And we've seen that a good bit across our IT groups, that they've actually been letting some of the senior people move on to industry out of the tech services business because they just, there's no profit, formula that covers what the cost of what that person makes. And there is somebody willing to pay them that isn't as sensitive. But when you're in that labor production type services business, you must get labor leverage or else you will cease to exist. And then there's just physics.
Yeah, I noticed that group too is very inclined to embrace technology though to try to gain efficiencies. A lot of them have really, they've done a good job of that in that particular field. And I've seen a lot of people too with this AI stuff. I have several clients making investments into AI for research purposes and things like that.
But here's the fundamental thing about our labor efficiency concept. When it comes to most of the service businesses that we deal with, I always look at the health diagnostic of a 2 total LER. So look at gross margin, so revenue after materials, contractors, cost of goods, but not labor. That gross margin needs to be $2 for every dollar of labor, whether it's direct or management. And that's a health diagnostic. The art of labor is, are you heavy direct, which means I got to be light management, or am I light direct and I can be heavy management? But I can't be heavy, I won't be profitable. I can't be light, or things will break and it won't work either. And so the most dynamic entrepreneurs that I work with, I can give them the playing field and say, listen, it's your choice. It's not my choice to tell you what direct LER should be and what management LER is, but it's my choice to tell you what total LER is. And if you're not at a 2, you're not going to hit your profit target. And that's for those service-based businesses. There's a handful of businesses like restaurants, distributors, companies along those lines that need to be a 2.5. And what's interesting, I'll just throw this out there. So like our HVAC, I'll tell you the secret of being a successful HVAC company. You got to get $2 of gross margin for every dollar of labor. Go figure it out. But that's it. And except if you're a union shop, you got to get 2.5. So if you want to know the cost of union labor for the same net production, you got to get 2.5 times instead of a 2, just because of the extra cost of the union cost.
It's free advice right there.
Yeah, but they just don't operate outside of that realm, in that regard.
So Greg, where do you see 25? I know we got limited data right now. I know I was looking at a little bit of 24. It looks like we might be finding bottom with some of the mid companies in that model. Where do you see 25 going based upon what we saw at the end of the year?
So a lot of it is going to depend on labor. And so, yeah, there's a lot of talk about tariffs, and yeah, you can argue that tariffs are inflationary, but you don't know the reaction of the country that gets tariffs put on them, of whether or not how flexible their pricing can be. One of the things, if you're a company that is impacted by tariffs, just remember the tariff affects your COGS, not your revenue. And so if you're a 80% gross margin business, well, a 10% tariff is a rounding error. If you're a 10% gross margin business, a 35% tariff is a massive thing, or even a 10. So understand context is the first thing I would say. But there again, as we've seen, the Trump administration puts it up, takes it down. And one of the things that everybody just needs to understand, we do not have an effective compliance mechanism to collect and enforce tariffs. And I would probably tell you that tariff enforcement is probably more complex than Internal Revenue Code. From a
Oh boy.
from a flow of goods, if if you're in Australia and you know how to collect a VAT tax, you can collect VAT and tariffs in the same process. We don't have that mechanism already in place. And so that's something they need to look at. But it won't happen overnight. The other thing that is far, far, far more troubling to me is just looking at labor. I mean, I think, the two of you would agree with every client that we're talking to. We don't have a single client that has just a massively available pool of labor to go get at a price that they can afford and make money on. And so here's the dirty little secret, folks. The pervasiveness of high producing undocumented labor in the U.S. economy is way more pervasive than anybody wants to admit. And when you start taking those people out of the equation, and I am not for illegal immigration by any stretch of the imagination.
You better not be, Greg.
But I want to hear from the administration, who are you going to help us bring in? Because there's not a U.S. human to take that job. And, like you can, the H-2B visa program is quite effective when run properly and allocated properly, and not political football played with it. But here's the one thing: we have a client in Austin, Texas that used them successfully for their lawn care business until they didn't get their allocation. And the thing I do like about the H-2B is you got a Department of Labor wage determination that gives you a minimum wage that you have to pay them that's market based. It's not the minimum wage, the federal minimum wage. You can't even get a immigrant worker to work for that. But this was like 2015, and they were paying $14.50 an hour for the H-2B guys, and we could measure with our labor efficiency concept that the immigrant labor was twice as effective as the local labor. I mean, not 20%, not 50%, double. And they showed up for work every day. And then when they didn't get their allocation, bad things happen. And as we come to find out, I mean, you can't get a local person in Austin, Texas to mow grass for $14.50 an hour. Now you can get them to smoke grass for $14.50 an hour.
Yeah, that's day, right? Yeah. We needed that. We just bring Grikiani and is what happens.
I mean, the realism is these are people that throughout the country, this is not just on the border. I mean, this is pervasive throughout the U.S., folks.
Yep.
These people are serving your food. They're cooking your food. They're mowing your grass. They're working in the lumber yard. They're working on the construction site. They're on your roof, putting your roof on. They're painting your house. And I get it, but this is the thing that government has to understand. When you've allowed bad behavior with no compliance checks to run rampant for at least probably 12 years in reality, you risk a significant economic disruption. And essentially, just here's your case in point. We saw the $13 an hour labor go to $20 from pre-COVID to 22-ish. I predict you're going to see that $20 an hour guy now go to 25 to 28, maybe even 30, if you can get them. They may not even exist. And we're already seeing it to where there are people that we're producing that aren't showing up for work, and because they're afraid. And I get it. I mean, but there's and yes, there needs to be enforcement, but there also needs to be a plan to say, okay, you're going to take these people out of the system. Who's going to do that job? Because there's not enough people in the U.S. that can fog a mirror to take that job.
Oh, this is great, man. This is awesome. Greg, what do you think, man?
I mean, so here's my prediction. I mean, you can take this for what it's worth. I'm just a chicken farmer from Alabama. I mean, what do I know? But I'm saying we're going to see 7 to 10% inflation by June, just from the constriction of the labor market. Because here's the other thing, folks. They stopped the people coming across the border. And so we were already in a deficit of labor that needed some more people coming in. And so all that stopped, which is good, but who's going to do the work? That's what I want to know. And where's the plan to get the people to do the work? Because there's plenty, the one thing we have in spades is the United States, is we're still the most desirable country that people want to come into. Wow. And we've got that by a long lead over a bunch of folks. We've got to use that to our advantage and do it the right way. Do you want to use a Japan model where they bring in workers from the Philippines on a 2-year rotation and never allow them to be citizens? Okay, that's one method. You can bring them in and give them a path to citizenship. That's another method. Hey, y'all go figure that out, but I'm just saying in the now, when, you're going to see the restaurants close up that can't get labor. You're going to see the construction projects. One of my construction clients has jumped from getting to jobs within 3 months to now 6 months because his subs can't get to it, because the subs have lost their extra bodies that did the work that nobody here wants to do. Who's going to do it?
Hey, if you want to work, we got to get him in here. I mean, that's it. If you want to work and be productive, we'll take you. Yeah, for sure.
That's it.
Well, Brandon, yeah, go ahead.
I was just going to add. So those are a few highlights. We've got a lot more information from this 100 company model. And part of our community model with our clients is that we're going to have an hour-long webinar. It's interactive. Greg's going to host it to go through not only, some more in-depth data around that, because there's some really interesting trends. We didn't get into capital. We're going to talk about capital on that. We're going to talk about some other trends that we're seeing, make it interactive. So benefit of being a Simple Numbers client and part of our community, you get to hear that, right from Greg as to much more detail than where we're going. But hopefully you've got some pretty good nuggets. Like I said, the table's set. It's just a matter of, do we have enough humans to do the work to keep the economy going? Yeah. That's the question. So if y'all figure that out, let us know. And more importantly, let somebody in Washington know. Good luck there.
And I will leave everybody with this. The one thing that, we like to try to attract the best of the best businesses. And for years, we've talked about building culture. This is something throughout my EO, community. We talk a lot about building good culture. But I can tell you, probably prior to COVID, I couldn't show you where culture made a difference on the bottom line. Now, you had a happier existence, but you sometimes weren't as profitable as the people with a bad culture that you had to put up with other things to make money. For the first time in the last probably 2 to 3 years, kind of through this COVID phase and coming out of it, we started to see the separation of the good culture businesses are the ones that are actually able to gain market share in essentially a flat economy. Because as we've said before, if you want to grow, you got to go take your fist and punch your competitor in the mouth and take their business away from them, because this is not a growing economy in almost all sectors. And so therefore you're playing a market share growth game, not a get my share of new growth game. And that is a totally different thing, where culture really starts to play, I think, a much bigger role in stability and people willing to go the extra mile, the people that, when you need to onboard a new customer, they're willing to work extra. And yet you have a flexibility where, okay, they'll take a day off other days. And you have more of that flexibility environment where people don't feel like somebody's taking advantage of their coworkers.
Right.
And it's really neat to see that finally culture is starting to take the center stage of elevating in terms of profitability and sustainability as a business model.
I love it. Yeah, that was a good one. And I mean, real quick, I mean, I'd like to apologize to the people of Austin, Texas. You know, we don't, you know, you might like to mow grass, and that's cool. There's nothing wrong with that. Just kidding.
That's not universal to Austin. I think that's pretty much universal anywhere.
Yes.
It's a great line.
A lot of our listeners also listen to the 21 Hats podcast, which this past week was covering what do you do when people show up to work high?
Yeah.
It's like, okay, here we go. So, folks,
Hey, listen, back in the day, I tried to get.
Well, as Jerry Seinfeld used to say, and there's nothing wrong with that.
Hey, one time I went into my annual review with Greg years ago and told him if I could put a drink bar in my office, he could forego giving me a raise, but he declined. So maybe I'll try that again now. Or I got to ask Mr. Carr. I don't know. But anyways, or maybe it was Donna. I think it was Donna. That was definitely a no.
time with a Mike Maxon who doesn't have that. We don't need a Mike Maxon.
That's right. Yeah. Well, awesome, everyone. Hey, appreciate you joining us for Greg and Brandon. I'm Mike, and we'll catch you next week. Have a good one.
See y'all.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Apple Podcasts, Spotify, or wherever you prefer to listen to podcasts. If you liked what you heard today, please leave us a review. The views expressed on Profitability Playbook, the Simple Numbers Podcast, are those of the presenter and moderator and do not necessarily reflect the views of CRI Simple Numbers or the CRI family of companies. This podcast is intended for informational and educational purposes only and is not intended to replace professional advice received directly. Consult with your CRI Simple Numbers advisor or another trusted professional if you have questions about your specific situation.